Welcome to the Alternative Investing Club show, Interviews with Operators. My name is Daniel Homland, and we bring to you interviews with people that are putting together funds in different types of private investments. That includes real estate, that includes oil and gas, that includes renewable energy. And today we have a very unique and interesting business model, and I'm actually really excited to hear about it because it's something new, and I always love digging into new types of investing, particularly if they're non-correlated with what we're already doing. It gives us another diversified strategy. And so today we have with us Brandon Dorr and John Nozel. And apologies if I didn't get your name correct. You can correct me.
Close enough.
Welcome to the Alternative Investing Club. Go ahead and introduce yourselves really briefly. Let's give like a 1 to 2 minute introduction, and we'll go into your fund.
Sure. Brandon, I guess I'll start. Hi, I'm John Nozel, co-founder, chairman, and CEO of Access Alternative Investments. In a very quick summary, I'm a former investment banker turned operator of companies with about 40 years of experience in the financial world. And a good portion of that, about 20 years of that, in aviation finance, an area that I started in and cut my teeth in back in the early 1980s. And that's probably enough for now.
All right, Brandon.
Yeah, no, thank you, Daniel, for having us today. Brandon Dorr here, Chief Investment Officer and Portfolio Manager at Access. Spent the bulk of my career investing in various industrial assets, transportation assets. Have a traditional training investment banking similar to John, but have spent the bulk of my career on sort of the investment management side at private equity firms, and look forward to showcasing what we have here at Access with everyone on your side, Daniel.
Okay, I'm really interested in this too because it's completely different than anything we have ever talked about before. Normally we talk about real estate or oil and gas. Those have been our two wheelhouses for the most part. But in 2025, we're finding there's an infinite world of private investment out there, and education is a continual, lifelong process. So, why don't you introduce to us what your fund does and how you operate and how you provide an investor return?
Sure. Why don't I start, and I'll give you incorporate into that a little bit of the background on Access and why we created Access about 4 or 5 years ago. Several of us got together, several of us who have known each other for literally decades, and who have largely been in the transportation finance world. And what we decided to do was bring to individual investors and some institutions, but largely individual investors, the kinds of structured financing opportunities that we all had been doing for decades. And these kinds of investment opportunities had not really been available to individual investors to that point. And we figured out ways to do it that are not, frankly, dissimilar to the kinds of structures you would see in real estate. But because you're dealing with multi-million-dollar assets that you can pick up and move, things get a little bit structurally tricky, and that's where our experience comes in. So that's a little bit about Access and why we formed it, essentially to democratize the ability to invest in an asset class that heretofore had been the domain of institutions. We do have background in other sectors, but such as infrastructure, such as maritime and other branches of transportation finance. But for a number of us, our wheelhouse really is aviation, and that's kind of what we do. Brandon, do you want to talk a little bit about our aviation strategy?
Yeah, high level, going up 30,000 feet here.
I love the pun.
There you go. Want to give you the broad strokes. In the first instance, we focus on assets that have a cash flowing nature to them. Okay, we have discernibility into those cash flows, whether it be the lease rentals, whether it be the end of lease compensation, whether it's the residual value. We have visibility and discernibility into those cash flows, and the emphasis on that approach is very paramount to how we go to market. We take that sort of deep dive, research-driven underwriting approach, and we largely focus on aviation assets such as the aircraft and the engine that are on lease, and so we can underwrite that lease stream of cash flows. Other assets that we may also incorporate and source and originate could be anything from helicopters to flight simulators, aftermarket spare parts, hangars, as well as helicopters, if I didn't mention that. So there's a large sort of broad ecosystem within aviation with a whole host of assets, including ground equipment, right? But our core focus, our core endeavor is to really target the engine and the aircraft and its leasing capabilities out there with airlines. So in the first instance, our strategy is truly to focus on those cash flowing assets that are on lease to airlines out there throughout the world. The next core sort of pillar and facet of our strategy is that we seek to sort of always provide downside risk protection, right? And so you mentioned earlier on that you're going after investments that are sort of non-correlated, and aviation is just that. When you think about the public markets, whether it's the equity or fixed income markets, aviation is somewhat insulated from all of that volatility that exists outside in the public markets. And so, in fact, in many cases, it serves as a hedge against inflation. So we love the asset class for those various reasons. And our team is very, very experienced. Some of us having 4+ decades, and all of us having at least 2+ decades of experience. And so we take that sort of set of relationships that we have with various parties, whether it be a lessor, whether it be a major airline, and we're sourcing and originating opportunities all over the world. Basis a deep bench of experience, having traded in and out of these assets, managed these assets, and so when we think about what we're building, just generally as a fund, right, we're seeing the cream of the crop from all different aspects in all parts of the world. And that team experience, right? I mean, just to give you a quick flavor, we've done over $120 billion worth of deal volume. That spans over 200+ years of experience. We've got guys in our team who have spent over 30 years of their career at major aerospace and defense companies like Pratt & Whitney and Raytheon. We've got other folks who have truly for 4+ decades bought and sold almost every aircraft type you could possibly imagine. Our in-house counsel is an expert in structured finance within the transportation space. Got other guys similar to myself who have private credit and private equity investment management experience delving directly into this asset class in aviation. So we take all of that with the relationships with the airlines, the lessors, and we package it all up, and we're bringing a sort of wealth of experience, which really matters, right? When you're thinking about investing in something, you want to have a team behind you who really understands what they're doing. So that's key for us. The other aspect is when you think about our strategy, we take a sort of an active approach. When you think about how you manage assets, month to month, quarter to quarter, year to year, we take an active, hands-on approach. We're in the weeds. We understand all the piece parts down to the APU, the engine, the landing gear. We're in the thick of it. And so we take great pride in that style and that approach. And I think that's a key differentiator for us. So high level takeaways for the strategy. It's truly an asset base with downside protection, going after core engine aircraft leasing opportunities, leveraging 4+ decades worth of experience that I think is really a key facet and pillar. So I'll pause there. John, I don't know if you want to add anything.
Well, I was just going to say that it's I think important for your members to note, Daniel, that we've done our business with some of the largest financial institutions in the world. I mean, I, for one, worked for Chase Manhattan, JP Morgan Chase for about 20 years, and then was involved in running one of the largest commercial aircraft leasing companies. I'm going to talk a little bit about that in a moment, not about me, but about the industry at large. But our aim is really, and I think, when we were talking earlier, you used the term institutional quality. That is a mantra for us because that's all we've ever done before this. If there's a household name financial institution that invests in aircraft, at least some of our team has either worked for them or worked with them on transactions. And Brandon mentioned our general counsel. He literally wrote the book on aviation finance. You can buy it. You can buy it in Amazon if you want. So, Brandon, I thought I would segue into kind of why does aviation finance exist, and what's it all about, and what the history has been, because I think it's important, Daniel, for your members to understand how this has evolved into something that has created such interesting investment opportunities in the alt space.
That's great. You're definitely anticipating exactly where I want to bring this, and I'm actually enjoying this a lot, because I'm in a more unique position in that I know absolutely nothing about the aviation industry. I'm like a brand new investor who's learning things for the first time. And so I could really put myself into the shoes of somebody in the audience who is just, for the first time learning these things and asking the question. And I think where you're going was going to be my number one question is, why are the airlines leasing these? Don't they own them? Why is there a leasing model in existence with the airline industries rather than just an asset ownership model? And what's brought about the creation of that market?
Sure. So I mentioned earlier that I've been around this space since the early 1980s. Okay, and so call it 1983. And at that time, the leased aircraft market, if you look globally, comprised about 5 to 7%, certainly less than 10% of all commercial aircraft in use by airlines. All right. And back in those days, sure, there were leased aircraft, but they were done on what was called capital leases or full payout leases, which is really even or leveraged leases that are really debt financings, full payout debt financings by any other name. And then, of course, there was debt financing that was done by airlines too. And in those cases, the airlines were really in the driver's seat in terms of structuring the financing, arranging the financing, and they for all practical purposes owned the aircraft, okay, even if they weren't the tax beneficial owner. Well, there were a couple of companies that were created in the late 70s and early 80s that had ambitions that no one ever thought would be achieved. Those were called Guinness Peak Aviation, or GPA, and ILFC, International Lease Finance Corporation. And they were the two first real operating lessors of aircraft. And attributable largely to the table for the airline operators, that segment of financing aircraft has grown tremendously. And I'll explain what some of the drivers are. But today, just to put it in perspective, close to 70% of all of the world's commercial aircraft are owned not by the airlines themselves, but by operating lessors. Okay. And for the kind of financing that we do, the kind of investments that we offer, we step into the role essentially of being an operating lessor. Okay. So we are the owner of the aircraft. Our investors, our fund, would be the owner of the aircraft through a special purpose vehicle that we create. This is how these transactions are always done. But the point is, it's not the airline itself. Now, why? Let's take a brand new aircraft that may be Airline X, British Airways, okay, is taking delivery of. Let's say it's an Airbus A320, one of the most broadly used aircraft in the world today, narrow body aircraft. Well, why would they make a decision to lease it versus buy it? And it all has to do with their fleet planning strategy. These are transactions that for a brand new aircraft are typically initially the lease term would be 10 to 12 years at most. And it gives them flexibility to manage their fleet. And it gives them flexibility from a balance sheet standpoint. They don't have to be responsible for raising all that capital to buy the aircraft. It's a lot gentler for the airline itself from a leverage standpoint, from a balance sheet overhang standpoint. Okay, and so why do airlines do it? They like the flexibility, and they like the absence of large capital outlay up front.
Yeah.
Okay, so those are the real drivers. And then what you have going on is a very robust secondary market for the aircraft. So let's say an airline, maybe a top tier airline, says, well, I'm not going to operate an aircraft that's more than 10 years old. So for them, operating leasing is very attractive because at the end of that lease, they just hand it over to the lessor who, approaching that end of that lease term, they're already out marketing that aircraft to other airlines that may not have that requirement about age of aircraft, because commercial aircraft can last anywhere, I mean, depending upon the type of utilization, anywhere between 18 to upwards of 30 years of useful economic life. Okay. Mm-hmm. So you have, if you're an airline, an aircraft operating lessor, it's kind of the gift that keeps on giving, because you've got this asset that will have multiple lives with multiple operators, and parts of that aircraft retain their value very, very strongly. Engines in particular, properly maintained engines, and there are very stringent requirements on the operators. That's an important thing to know. The operators have the maintenance requirements for the aircraft, operator meaning the airline. Okay, so some of the components of the aircraft retain their value very, very well. Our particular, and Brandon's going to get into this in a minute, but our particular approach is to play with older aircraft, to take advantage of the near end of life and the utility of those parts. So some of our transactions are what would be called end of life transactions, where we buy an aircraft subject to a lease. You have the cash flow coming in to you from to the operator. Maybe we have raised some debt associated with it in addition to the equity, essentially created a miniature leveraged lease, if you will. Lease rentals come in, satisfy the debt portion, and then there's the remainder of the rent that goes to the equity investor. That's how the transactions work. And then at the end of the useful economic life, the asset either gets sold to a part-out company, or we would engage with one of our strategic partners and part it out ourselves. That's kind of the way it works.
So two questions really quickly then. Do you purchase all of the assets that you lease out, or do you have an arbitrage strategy where you're leasing from another party and then releasing them to the airlines? Or do you have a combination of the two?
No, we would, the way these things work is you don't, the market is efficient enough that you wouldn't stand in the middle and be kind of there.
Okay, so there's not a viable arbitrage strategy.
Well, let me couch that a little bit. There are certainly what's called subleases of aircraft. Okay, that's where you have a head lessor, a lease to a sublessor, to a sublessee / lessor, and then on to the ultimate operator. But normally when you see that, the guy in the middle happens to be an operator that for some reason has either a temporary or permanent desire not to operate that particular aircraft.
Okay.
So it's more for operational strategic reasons, not to take advantage of a financing arbitrage. Does that make sense?
Yeah, absolutely. And Brandon, I'm not sure where you're going to go, but I definitely want to hear about what happens to equipment when it's end of life, and what's your due diligence process since you're buying equipment that's near its end of life. But if you had a different topic you wanted to go on to, we can hold those two.
Yeah, let's hit those.
Okay.
Maybe John, maybe now is a good time to sort of transition, where we talk a little bit about why aviation as an investment class is purely attractive, from an investor standpoint. I think let's sort of start high level and then dig deeper where you just mentioned, where you wanted to go, Daniel. Piggybacking on what John mentioned, let's let's answer the question, why aviation just generally as an asset class? And first, let's start with the fact that they're long-lived assets. John mentioned that they have a life of 18 to 30 years, right? The predominance of what we're going to be focusing on from our fund strategy will be the mid to end of life asset, which is the asset that's roughly 12 to 20 years of age, okay? And most of what we're going after from both a narrow body and wide body aircraft will have a useful life that's closer to 18 to 23 years of age, plus or minus, before it's dismantled and torn down. However, with the big caveat that several different aircraft type, including cargo freighter aircraft, as well as turboprops, they tend to have a longer useful economic life, closer to 30 to 40 years in some cases. And especially if it's an asset that was converted to a freighter, right? That could have an even longer life. And the turboprops that serve as island hoppers and go to the short little routes that are economical.
I got to jump in there. I don't know what a turboprop is.
Oh, okay, fair enough. It's effectively an aircraft. If you've ever been, on an island where you see the loud jets that have the propellers that you can look out the side of your window and you see the propellers outside of the
okay.
Yeah. Okay. So those effectively are your turboprop aircraft. They make a ton of noise, but they're much more fuel efficient to a certain extent and have a cost savings to some airline operators. That is still very. And by the way, from a takeoff and landing, they may have other benefits from a strategic standpoint in terms of how you operate them with the runways and the locations and their ability to sort of come in and out of different jurisdictions. So,
Brandon, just to interject, because I think Daniel's curious. The reason they're called turboprops is because if you take a look at the engine on those aircraft, you've got a propeller, but right underneath it and behind it, you have it's almost like a hybrid, and you've got essentially a jet engine component there too. Okay, so turbines as well as a propeller.
Gotcha. Okay.
So when you think about what we're doing, as we focus on the mid to end of life asset and the fact that there's long lives to these assets, that gives a lot of flexibility to trade in and out, to buy and sell, to hold it while it's leased, and then to trade out of it. So because of that useful economic life being such of a long duration, it provides us with a great deal of flexibility when we want to go exit and monetize and harvest it, and gives us optionality. We could release the asset post lease expiry if it still has green time, what we effectively say useful economic life of green time life, or we could dismantle it if in fact the benefits of tearing it down, which we'll get into in a minute, outweigh the benefits of releasing it, right? Because a lot of times you have to continue to replenish through capital expenditures. You have to replenish the engines by going and doing a shop repair, by doing an overhaul. Same thing for landing gear, same thing for the AP, all different aspects. There may be capital requirements that may not be worthwhile to spend at that time in its life when it gets to be 18, 19, 20 years old, and it's more economical to tear it down, where the parts themselves have a great deal of value, which we'll get into in just a little bit. The next aspect, when you think about an aircraft, right, and it's out there trading, right, it has a great deal of mobility versus real estate or your oil and gas exposure. Those are fixed to the location in which they exist, which not a knock against them, but as a differentiator. When we get to the end of our lease, and it's in the case of John Nozell mentioned, if it's on lease with British Airways and the next operator is Air New Zealand or somewhere down in Central South America, there's a portability factor to that asset that puts us in a position to have a great deal of flexibility to otherwise maximize the revenue stream on that asset. So that mobility, portability factor is pretty helpful to us.
That makes sense. You have a wider possible target audience, I suppose, for the reseller. Reselling.
Right. The next is liquidity. When you think about different asset types out there, whether it's your real estate, whether it's manufacturing equipment, whether it's a piece of infrastructure, aviation assets have a liquidity factor that's a great deal higher than other asset classes, right? And primarily where we're focusing, which again is that mid to end of life, that 12 to 20-year-old asset, right? As John mentioned, that first lease for that brand new aircraft may have a 10 to 12-year lease, but the mid to end of life asset may have more like a 3 to 5-year lease or 4 to 6-year lease. And so because of that, there are lots of folks, there's a pretty mature market out there of buyers and sellers, lessors, who trade in and out of these assets, hold them for a certain period of time, and then sell them to the next lessor. And that market is very visible. We have insight into it. We can see how the assets perform, how they trade, and the values are discernible to us. We have a great deal of clarity there. And so when we think about what's the best, highest economic use of our LP dollars, the fund's dollars, when you invest in aviation, right, you can understand when and have greater certainty of when you enter and when you exit, what your return profile looks like, because you also have visibility into the cash flows while it's on lease. Okay, so when we think about liquidity, it's an important aspect. And there's what I want to talk about. You mentioned disassembly and tear down and part out of the asset, right? That market is extremely robust. Okay, there's a whole set of what we call MROs, maintenance, repair, and overhaul organizations who have a goal. Their business is set up to effectively repair, overhaul, and take certain asset components of the aircraft and engine, whether it be the APU, the landing gear, the avionics, and they repair those piece parts, right? And then they put them back on wing to continue to allow that aircraft to be airworthy and continue its useful economic life. And so when you tear down an aircraft, right, let's say you bought the aircraft for $5 million, right? The parts themselves could be worth double or more once you disassemble them and sell them back out into the marketplace to the various repair shops and MROs. And then, by the way, if I didn't mention it, MRO stands for maintenance, repair, and overhaul organization. So liquidity is a key sort of facet of our strategy and why aviation is attractive. The next is more about, yes.
I think an important thing to interject here about liquidity is, why do these assets move around in a secondary market? Okay, because some people who aren't familiar with aviation have asked me, well, why would a perfectly satisfactory aircraft with a perfectly satisfactory operator under perfectly satisfactory lease conditions, why would a lessor want to divest of that aircraft? Okay, and the reason is, and I was there. I ran a leasing company that had about $10 billion of aircraft, and the reason is purely for strategic purposes. Let's say you have an order book of 100 aircraft, and let's say you have a high concentration of existing leased aircraft to operator X. Well, you might be saying, oh, gee, I want to place some of these new deliveries with operator X, but I don't want that much exposure. When I look at my overall portfolio, it gives me too much concentration. So it becomes a risk management exercise, not because it's a bad risk, just because they're managing to a balanced portfolio. Okay, and that can be for regional reasons. It can be for operator-specific reasons. It can even be for aircraft type reasons within a portfolio. And in some cases, you have lessors who are organized as a series of private equity funds. And there may be fund-related reasons, such as the expiry of a fund, okay, that they may want to sell an aircraft. So these transactions happen all the time. And that's very important for your members to understand and in our case, one of the big advantages that we bring to the table, because a few of us are fairly long in the tooth, is that we have long and deep relationships with a lot of the people who are buying and selling these aircraft in the secondary market. We also have relationships with the operators themselves, and that can sometimes make things a lot easier when you're transitioning an aircraft from one owner lessor to another, such as to us, or from us to somebody else. Sorry, Brent, I wanted to make that point.
No,
it really does speak to the robustness of areas or fields that have secondary markets, because oftentimes if you have just a single investment and there may be conflicting reasons to buy or to hold it, or people that second guess the strategy of the operators of that particular investment, when there's not a secondary market helps you with all of the other reasons why you might want to buy and trade. And I think you explained that really well, in that you might have a perfectly good, component or part or whatever the investment in the asset happens to be, but there can be secondary considerations from the fund or from a portfolio balancing standpoint that will that are addressed by the existence of a secondary market. And it speaks to the robustness of fields that have such a market. And so thank you for explaining that.
Sure. Sorry, Brandon. Go ahead.
No, absolutely. A good point, John. The next sort of aspect that I touch on, Daniel, is more of a financial benefit. These assets, being hard assets as they will, they have a depreciation profile to them, right? Some of these assets will be operated in foreign jurisdictions, as I said, whether it be in Australia or in Europe or in South America, and other assets will be operated within the U.S. Domestic route system. And so if it is a U.S. operated asset, right, and we've purchased several of them before, and there's a depreciation profile there that's, significant, right? In the case of 2025, I believe the accelerated bonus depreciation schedule is 40%. Okay, and that will continue to change, and maybe the new political regime will perhaps augment that as well, but that's a TBD. If it's a foreign asset, there's a 12-year straight line depreciation schedule. So there's a lot of potential expenses that run through the system that offset income, which could be a beneficial play for those who have passive gains, for those investors who have those gains that can utilize these depreciation losses. That's a bonus.
What? I got to ask you here, just, in ballpark figures, what sort of depreciation does your fund allow investors to take? And what, for a dollar put in, for a real estate deal, you'll often see, somewhat larger depreciations, often in the first year because of bonus depreciation, and it can vary from asset class to asset class as to what the percentage is. With RV parks, it's going to be 90%. With other types, it's going to be 25%. What do you have an area that you typically operate in for passing depreciation through to investors, or is it more variable?
Yeah, I would say it's a bit variable, and I also sort of caveat saying, we're not accountants and don't want to provide sort of tax counsel necessarily, sure, but generally based on that, bonus depreciation schedule in combination with the fact that a lot of these positions we're putting leverage on, we're putting debt on. So the amount of equity invested in the single position offset by a significant amount of leverage, right, creates a depreciation schedule against what's invested, the equity amount, whereby typically you can get pretty darn close to, in at least the analysis we did recently for 2024, you can get pretty darn close to having an offset of depreciation losses that are almost equal to your equity basis in that particular vintage year. So but that's going to change year to year, and that's going to be based on the depreciation schedule of that particular asset.
I guess what I'm asking is there a strong depreciation component, or is this something that investors should approach with the mindset that they're really not going to get depreciation from?
Oh, no, they definitely will. Listen, we're going to have a good mix of both U.S. and foreign assets, so there will be a healthy amount of depreciation and losses that will pass through on the K1s. Fascinating.
Great.
Yeah. And obviously it skews higher the more U.S. assets we have.
Right.
Okay. You actually mentioned one thing that piqued my curiosity really quickly. You said for foreign-owned assets, there's a 12-year straight-line depreciation. Is that a U.S. rule that applies to all foreign entities, or is it just that foreign entities have adopted that as a standard? Why? It was a very large. I would have thought that every country that you leased it to would have had a different depreciation potential scheme, and.
Well, so bear in mind that the partnership, not to go too deep, the partnership that we've set up is a U.S.-based Delaware partnership. Okay, yep. And when we own assets in foreign jurisdictions, we typically set up a pretty complex funding structure whereby the special purpose vehicle that has title to the asset usually rests over in Ireland. There's special sort of tax withholding treaties that exist from country to country, and Ireland has a large set of withholding treaties and exemptions that apply, and so therefore it's a very call it convenient and preferable position to. And so as we fund dollars from our U.S. based fund over to Ireland based on a very set of complex, call it PwC, KPMG approved schedules, right? All of that cash that comes back will be blocked and will block all the taxes properly and put in place a very, very robust sort of organizational schedule. But because the fund is set up as a U.S. partnership, right, it's going to be subject to all of our fund accounting and GAAP policies, which will then effectively state that the 12-year depreciation schedule is what it is for foreign assets.
Gotcha. All right. We are at the 35-minute point right now. Were there any other large topics that you really wanted to cover? We could keep going if you want, but at this point too, if we want to close it off and kind of give a conclusion, we can do that as well.
So, Brandon, I think risk mitigation is something that really needs to be discussed.
Okay.
Yeah.
Do you want to handle that?
Why don't I?
Cape Town?
Yeah, I'll go through that, but let me I'll nail a few points real quickly. Daniel, I think they're important to mention. We'll sort of maybe speed through it more quickly. The other aspects of aviation that we want to mention is these assets generate income on a current pay basis. So while you're not sitting there making a $100,000 investment, waiting 5 years and getting your money back, you're going to get quarterly distributions and current income. So that's a core facet of this opportunity set. The next, as I mentioned, these assets are uncorrelated, right? That's a key facet, right? So it's a hedge against inflation. It's uncorrelated to all the other asset classes, including the publicly traded markets, right? That's a key asset. And then there's resiliency. This is a key factor. This goes to what John Nozell was mentioning. When you think about the oil crisis in the 70s, you think about 9/11, you think about the great financial crisis, COVID, all these different exogenous shocks to our global economy, right? Aviation has always sort of bounced back extremely well, and in most cases, almost even stronger. And when you think about then the resiliency from a credit airline perspective, if there are ever any defaults or any circumstances that come up where the operator, the airline is effectively in default under the lease terms, right? There are protections that are unique to lessors in the aviation space that unlike any other industry, right? And in one case, it's called the Cape Town Convention, where the owner of the asset is afforded to get back the asset with a certain time frame. There's also Section 1110 in the U.S. Bankruptcy Code, whereby there's to long story short, there's effectively a program and policy set up whereby the airline has to make a decision within effectively 60 days. They either make us whole and current on what we're owed pursuant to lease terms, or they have to give the asset back to us, in which case this comes back to the liquidity factor and the demand profile of the asset, where we can go back out into the marketplace, remarket it, put it on lease with a new operator, and be back in business again, maximizing that revenue stream. So these protections, Cape Town Convention, which most airlines and countries are part of it and have agreed to, as well as the U.S. Bankruptcy Code, Section 1110. These are very, very, I'll call it monumentally important fundamental protections that are unique to aviation, with which we benefit from as a lessor, as an owner of the asset. I don't know, John, if you want to add anything to that. I know you.
Sure. I lived. In fact, I was very involved. In my first job, I was the young bag carrier at the time. But the first airline bankruptcy, the Continental Airlines bankruptcy that started in 1983, was the first bankruptcy that tested this Section 1110 of the Bankruptcy Code. And I was actually involved in the creation, in the early days of the creation of the Cape Town Convention, which was meant to mirror the protections that Section 1110 provided creditors and lessors in the U.S. outside of the U.S. And there are, I think, 160 signatory countries to the Cape Town Convention now, something like that. Mm-hmm. So I think Brandon hit the nail on the head, that you have an asset and with a financial profile that is completely uncorrelated in certain respects with the sort of the financial trials and tribulations of the operator. And the reason I say that is, if you take a look at publicly traded airline equities, okay, they tend to be fairly volatile. And airline revenues tend to be very seasonal, depending upon which part of the world they happen to be in, okay? And the volatility of their stock prices reflect that. If you are an investor in an aircraft, in an operator, you don't care whether its equity trades high or low, because your investment is in an asset. And if the people that you're working with, people like us, have done a good job of making sure that that asset is existential to that operator's fleet, your risk is really, your risk is binary, one, in that nothing is going to happen unless there is a bankruptcy event, which is fairly extreme. right? It happens, but it's fairly extreme. And then, even in the event of a bankruptcy, you have this wonderful protection that says within 60 days, the bankruptcy estate has to decide, do I want to keep that asset or not? And the only time you really have a ripple through the industry, and as Brandon alluded earlier, they've always been temporary, is when you have a catastrophic, globally catastrophic situation, such as a global pandemic and things like that. Okay, but by and large, if life is proceeding as planned, the trials and tribulations of a single operator don't really concern you all that much. Anyway, that's my 2 cents.
Well, gentlemen, I am going to throw my surprise question at you now that I ask every person that comes on here, and it's not a huge surprise. I would love for each of you to recommend one book that our audience could read, and it could be about airline industries and the history or the finance of it, in your wheelhouse here, or it could be something completely different. Just because I don't know much about it, I'd love it maybe if you did recommend an airline book, but feel free to recommend anything you want. One book recommendation.
Well, do you want to start, Brandon? Because I'll do the easy one.
Well, I was going to say, do you get the easy one? Oh, boy. John, you go ahead with the easy one, and I'll come up with a non-aviation one.
Okay. Can I give you two? One is a great reference source, and that is the book written by Ron Scheinberg. I believe it's called Aviation Finance.
Okay.
Catchy title. It says what it is, and it's available in Amazon. It gives you anything that you would need to know about understanding the structures of the kind of financing structures that we've been talking about.
All right. Looking it up here. Is it the Commercial Aircraft Finance Handbook?
That's it. Sorry.
There we go.
I abbreviated the title.
No problem. No problem. And
by
it's
Ronald.
It's a book. This is a book I would definitely recommend in the secondary market. It looks like quite the book. All right.
I'm actually going to stick my neck out and offer a second one, only because it's something I'm reading at the moment and it's personally relevant to me. It's kind of a business memoir written by the guy who was the chairman and CEO of Continental Airlines at the time of that first bankruptcy. It's called Flying for Peanuts, and it's by Frank Lorenzo.
All right.
And it gives a very interesting history on that time period in aviation. And I'm in it by reference, not by name, and I'm happy that it's that way.
All right, Brandon, you're up.
I'll give you two as well, but I just throw a curveball at you. Non-aviation book. It's a book called Boys in the Boat. It's about a rowing team from the University of Washington. They made a movie about it recently, but very, very interesting book about that team and how it went to the Olympics, and that's a curveball for you, knuckleball, I guess, if you will. Anyway,
1936 Olympics.
There you
Excellent.
go.
Love it.
But the other one is, again, I would stick with Ron Scheinberg's book, but there's another one called Aircraft Leasing and Financing. I think it was written back in 2013, 2014, by a handful of authors. I think the last name, it's not ringing a bell, D'Agostino, I think, was one of them. But Ron Scheinberg's is the be-all. I would stick with that one.
Yep. D'Agosto, Raghavan, and Gustav, apparently, the authors. Right. Excellent. Thank you very much for the book recommendations, and thank you so much for bringing a different take on investing to our group here. This has certainly been a unique business model, and I will definitely invite you to come and present on our Friday meetings. I would love to review, your legal documents and go put you through my own due diligence process. But I imagine that there's probably a good likelihood that we'll be very interested in what you have here. So thank you very much for being at the Alternative Investing Club show. We're going to bring you in on a Friday meeting, probably in February at this point. And thank you very much.
Daniel, it was a pleasure. It was a pleasure.
Yeah,
Thanks for
thank
having
you
us.
so much, Daniel. This was good fun. Really good fun.